Welcome to another edition of Coffee with Kirk. Really glad you could join me today. It's going to be a little shorter than usual. I had an off-site meeting this week, which I'll talk about at the end. Kind of has to deal with the future of Picket Fence Financial, but exciting things. So I didn't have quite as much time I was hoping to. But I had a few slides that I kind of picked out through the week and would like to jump into that because you know I love my slides. So we'll get into that. So today I'm just going to talk a tad about really building on what we talked about last time, the Coffee with Kirk. And I'm going to specifically look at just kind of the ridiculousness with what's happening with a few tech stocks. It just feels like 1999, man. I tell you. So we'll talk quickly about that, and then just got a little thing about had some questions about jobs numbers from a week ago, and then I've just got a little quick topic on the U.S. dollar. So we'll jump in real quick here. In last week's presentation, I kind of talked about how there's just not a ton of value right now in the market. If you're a traditional value investor and you look for cash flows and low valuations and low price to earnings and good return on invested capital and all those crazy numbers that don't seem to matter anymore. And the first thing we talked specifically about Warren Buffett. And I'm just throwing this slide back on there just to show you the amount of cash that Buffett has on hand right now. And you can see it's a massive amount of cash. So Buffett isn't a guy that tries to time the market or look at the economy in aggregate. He just looks for compelling valuations, good companies at compelling valuations. Not rock bottom cheap, but just compelling valuations. It's worth it over the long term to buy. And clearly, he's just not seeing it. So I always take note when one of the better investors of the world's ever known happens to kind of be, building up a cash reserves, building up a war chest. The other thing we talked about last week, I'm just going to refresh real quick, is, right now you can basically get about 5% on treasury bills. So that is a completely risk-free, you can argue inflation and you can argue the government's overspending, but as far as getting your money back, it's considered a completely risk-free investment. And because treasury bills are typically 1 year or less, then, it's not a long-term investment either. So it does mitigate the effect of inflation a little bit in that you don't hold it for 10 years and really let the compounding interest of inflation build up. So you can get 5% for no risk. And then what we talked about last week was the earnings yield on the stock market right now, which is essentially a reverse of the price to earnings. So you take the earnings of the stock market and divide it by the price. And that gives you a 4% earnings yield. So right now you kind of say, well, I could park my money and get 5% risk-free, or I could take risk, go into the stock market and earn 4%. This is just another way to describe the valuation of the earnings yield here. Essentially what I told you, you just take the earnings and divide it by the price per share. So this is just a graph of that showing that right now, the earnings yield on the S&P 500 is less than the 3-month treasury bill. And you can kind of see, if you go back and you see anytime this drops below zero, not really a great time to be an investor, honestly. The last time we really saw this happen was the year 2000. I also saw it in 1990, which was a recession. You can also see it there in 1987. And of course, back in 1980 and 81, same thing happened, along with 1974. All of those bad markets. Now, again, I don't know if I don't know if this means that we're going to see a big downturn or something like that. It doesn't mean that at all. But you try to look at the past to infer what might be coming down the road, and it's usually not a good sign when your risk-free yield is less than the earnings yield on the S&P 500. And the thing is, right now, when we look at the market, it is basically large tech. This chart gives you returns for this year through June 5th, based on, if you look on the y-axis, you have small, which is small capitalization stocks, mid-size capitalization, and then large cap. And then across the x-axis there, you've got value, core, and growth. And right now, the only sector that's doing very well is large growth stocks, and mostly because of technology. But you can see in the other areas, especially, in value, get the little hiccups here. There's really just not a whole lot of performance on any sector outside of that. Even large cap core has mostly been influenced because core is both growth and value. So in small company stocks have really not done well at all. And typically when you have the economy booming, you would expect to see smaller company stocks, because they're more nimble, flexible, and they can grow faster. They should be outperforming larger company stocks. And this just shows you that technology is the market. So this is the S&P 500 information technology sector divided by the S&P 500 overall. And you can see we're at levels right now in technology that we have not seen since the peak of the internet bubble in 1999. So this is it's just getting a little nutty out there. This is looking at the big three tech stocks. So NVIDIA, Apple, Microsoft. Apple actually has seen revenues and profits start to go down. Now they're still huge. It's a great company, but it started to really perk back up because, of course, they're announcing more integration with artificial intelligence, and they are going to buy back some stocks, about $100 billion worth of stocks. So that's a good thing too. But I think we're getting to the point where it's getting so far ahead of itself. And then, of course, NVIDIA and Microsoft, also very big players in the artificial intelligence. But you can kind of see the one that's really gone nuts here this past year is NVIDIA. And look, I used to recommend NVIDIA starting in 2014, but at this point, with these valuations, I just can't justify it. You're just hoping that the craziness continues, and it could continue for quite a while. But I just think we're got to be getting close to it, because this is just sort of a graph here that, you have the total stock market that's depending on NVIDIA earnings, and what's holding up the elephant on top of the beach ball is just a couple of ants. Something's going to go wrong here. It always does when things get like this. And just to kind of put it into another, again, these graphs don't really mean much when you try to compare it to the past, but they always say the past doesn't repeat, but it does rhyme. This chart on the right was Cisco back at the peak of the internet bubble. And even today, Cisco's a very good company. They're still the backbone of the internet. Still do just massive amounts of networking. But look at what happened to the stock price. And now I'm not saying that NVIDIA is going to drop like that, but boy, when you have a company that's grown like that, and it's now, close to a $3 trillion company, one of the three largest in the world, and you're getting that kind of movement, that's bubblicious right there, baby. There's just no way around it. You can, I've been telling people this for a year, and I certainly look wrong so far, but we'll see. Time will tell. The crazy thing is, it's even gotten to some other really good companies as far as the overvaluation. Like right now, Costco, great company. Everybody loves Costco. Go get your $1.50 hot dog. But right now it's trading at 50 times earnings. 50 times earnings. And to put it in perspective, what that means is if you buy a share today and the earnings per share stayed where they're at, it would take you 52 years to get your original investment back. I mean, that's absolutely crazy. And when you go back to 2005, which this chart does, and through, the next 10, 15 years, when Costco was really growing, adding tons and tons of stores, the price to earnings never really exceeded 30. So in fact, most of the time it was between 15 and 25. So all of a sudden, while it's pretty much a fully mature company, it's now at 52. So what does that tell you about the market behavior right now? And the thing is, if you look at it, this is a graph of the American Association of Individual Investors, and it compares investors who are bullish and bearish on the S&P 500. And right now, people are extremely, extremely bullish, as bullish as they've been since 2007. And, we've hit peaks at this. And the last time we had a peak like this, it was 2022, and then the market lost 25%. And you can kind of see every one of these peaks, the green line peaks, just go up to the top, and you can kind of see what the market did over the next months, even a couple of years. Not a great sign, but when everybody gets this bullish, you want to start to get a little bearish. Now, this is basically the same graph, but it's looking at the low points on investor sentiment. And you can see when everybody's really bearish, that's an excellent time to get into the market. So 2009, people were just horribly bearish. During COVID in 2023, all of that, you had massive bearishness, but that was actually a good time to buy. So this is a pretty good contrarian indicator if you're an investor. And again, just to show you kind of how narrow the move is in the market, this is the number of stocks above the 200-day moving average. I think it's 32%. Usually, if it's a really legit bull market, you'd like to see 50% or more or above the 200-day moving average. And then stocks performing the index, the S&P 500, that also is at really, really low levels. With the median being a 49%, you'd expect to see 49% outperforming and then 51% underperforming, which would make sense. But right now, we're below 30% that are outperforming the index. And the last time you saw that, I guess it was the 07, 08 period. So again, very narrow leadership in this market, usually not a good sign. And as if that's not enough to show you the risk taking, this is just a chart showing you the volume on penny stocks. So these are stocks trading less than $1. And people are looking to get rich fast. That's what we see when people are jumping into penny stocks. So a lot of risk taking going on, and just complete lack of any fundamentals at all. And what kind of alarms me a little bit is you look at a couple factors that maybe the markets are telling us things aren't as great as they seem. So we've got the 10-year Treasury starting now really to start to move downwards. So we were at 4.5%. 3 months ago? 3 months, yeah. Now we're at 4.2. So we start to see yields dropping. Now, usually it's a safety trade when money's running to longer dated treasuries. People are a little nervous, so they start to move to the treasuries. It could also be the fact that they think that inflation's starting to moderate. So when you're in a bond investor, you're looking for a certain percentage above inflation to protect your capital and your ability to purchase. You don't want to lose purchasing power. So maybe they're saying, well, inflation's moderating, but it's also typically a sign that there's money running to safety. And so this could be inflation. It could be safety trade. But the thing is, when you look at other asset classes that are typically a safety trade, you start to think that maybe that's what the market's telling us. So we've got long-dated treasuries that are perking up here, but we also have a strong U.S. dollar. So when people start to get nervous or antsy, a lot of money runs to the U.S. dollar, which the U.S. treasuries are essentially a play on the U.S. dollar. So this is, so far this year, the U.S. dollar index, it's gone up from about just north of 101. Right now it's at 105. So that could be it. And then you also see the fact that gold is also going up. So gold is another safety trade. So we have treasuries, dollar, and gold all going up, which is typically a way to say, hey, there's a safety trade here. You know, people are nervous. And the thing is, when we're in periods where people aren't thinking, you know, bad things are on the horizon, like gold and the dollar typically trade the opposite. So when the dollar is getting stronger, gold gets weaker. And when the dollar gets weaker, gold rises in price. We're not seeing that. We're seeing both go up, along with, we're starting to see bonds act like there's a safety trade on. So we'll see. Time will tell, but this is something I'm watching quite a bit. Now, I did get a question about last week's jobs number came out. So the establishment survey came in at 272,000 for the last month, and for the month of May, which is really good because some of the bigger expectations were about 180,000. So really blew the projections away for all the different investment banks that were talking about it. So surprised everybody. But the thing is, you have to start to dig in a little bit deeper. And what we find out is full-time employment actually dropped 625,000 jobs. Part-time employment went up 286,000 jobs. And the unemployment rate kind of perked up to 4%. So, is it really as strong as they're saying? And this is a chart just showing you full-time versus part-time work. Going back, and you can start to see this is a trend that's been happening for a while, where full-time is shrinking the number of jobs and part-time is going up. And the other thing that kind of alarmed me was the fact that the household survey actually saw a loss of 408,000 jobs when the establishment survey had 272,000. Now, the establishment survey gets all the press, and the way that's functioned is it is looking at, how many people are on company payroll. So, it looks at, how many filings that companies have, for payroll taxes, everything along those lines. Whereas the household survey, they call households and find out, are you fully employed right now or not? And so the biggest difference is if somebody in the establishment survey, let's say they have 2 or 3 jobs, well, one person who's working 2 or 3 jobs to make ends meet, on the establishment survey, that'd be 3 jobs because they're going to come through on 3 different companies' payrolls. Whereas on the household side, that would just be one person's employed. So what the household survey saw was actually a drop of 408,000. So how could we lose 600,000 full-time jobs, only put on 286 of part-time jobs, but yet they had 270,000 jobs of growth? Well, it's something called the birth-death adjustment. And the Department of Labor tries to determine how many businesses are formed and how many businesses fall apart every single month. And this is really hard to do from month to month. It's really something that you only discover after several months to see what really happened, how many businesses have been created and how many have been destroyed. So this is always kind of a very nebulous number. But you can kind of see the past 2 months, they've really assumed that there's been a lot of new businesses open to create new jobs. And for last month, it was 233,000 for the birth death adjustment. So that's pretty intense there. I don't know. In the month before, it was like 370,000. So, that's one of those areas you wonder, are they just fudging the numbers a little bit? And again, looking at the establishment versus the household, you can kind of see we're starting to see a serious gap between those two. Going back to 2019, this chart does, you can see there's been, pretty consistent correlation between both of them. Not perfect correlation, but right now what we're seeing is definitely a difference between those two. So one of them's right, one of them's wrong, or it's somewhere in the middle. But either way, I don't know. We'll wait and see what's really going on with employment. So the last thing I'm going to finish with here, again, it's going to be kind of a short presentation, is just, something that's on the radar, and it could be way down the road, but it's the dollar as the reserve currency. So right now, pretty much any country that needs to function, that needs to do trade, is going to be using US dollars. So even if India and Brazil were going to, trade goods and services, they're going to do it in US dollars. So they're both going to have to go out and get US dollars to trade back and forth. And this is from Luke Groman, who really looks a lot at these issues and saying, like, look, basically in 2014, 59% of all transactions or global reserves were the US dollar. So that means central banks' reserves, some banks, things along those lines. So 59% were US dollars, about 10% were gold. And what we saw at the end of last year was US dollar as the reserve went down to 49% and gold's up to 19%. So, but things are kind of changing here. It's still very heavy in the US dollars, but definitely a change that's happening that could threaten the dollar. And this just shows you what the Chinese central bank is doing. The percentage of, treasuries that they're holding in gold reserves. And you can kind of see they've made the decision to really start to drop U.S. treasuries and focus on purchasing gold. And just this week really didn't get much news play at all, but it really alarmed me, was Saudi Arabia is ending the petrodollar. So back in 1974, Saudi Arabia agreed for the next 50 years that they would only do trades for their oil in US dollars. So it created what they call the petrodollar. Well, this week, Saudi Arabia decided they're not going to extend that anymore, which means they can now sell their oil for gold. They could sell their oil for Chinese yuan. They could, sell it for, euros, British pounds, whatever they want now at this point. They are no longer mandated to be the US dollar. Now, does it mean they're going to stop overnight? No, it doesn't. But they're going to be more strategic. So maybe with the dollar being strong, they'll probably still do all their business in the dollar. But if the dollar really starts to struggle, you might find Saudi Arabia is going to look to trade in other currencies or even gold. So this just shows you that we need to get our act together, because once the dollar is no longer the reserve currency of the world, and there's not a huge demand for the dollar, which also means there's a huge demand for treasuries. At that point, we have to price treasuries at an interest rate that will pull investors in. And considering our massive debt, we could see our interest rates go up substantially. And what that's going to mean is it's going to end up meaning massive inflation for us, because more than likely the central bank will jump in, start buying treasuries. And the only way they can do that is to print money, which is going to effectively become inflationary. So this is definitely a big, big deal, which I haven't seen much news about it. Now, it just happened a couple of days ago. So, but it's a big deal. Okay. So like I said, it's a little bit shorter today. But we always finish with our disclaimer here. Don't mistake this for financial advice. We try to make sure their information is timely and correct, but we can't guarantee that. Talk to your financial planner before making decisions, yada, yada, all that good stuff. Okay. So let me jump back in here. Yeah, so the last thing I'm just going to talk about briefly, as I mentioned, I was in offsite. I'm still don't have all the details, but I just want to keep everybody abreast of what's happening. As I've been talking about, I did sell my picket fence tax business. I sold it to a local CPA. They're going to come in. They're keeping the name picket fence, keeping the same office, keeping the same employees, same software, same process. So it'll be as if nothing's changed, except for the fact that I'm not going to be doing the day-to-day operations anymore. It's just too overwhelming. I had trouble finding really good people to replace a really good manager that I had, Sherry. Some of you probably worked with her, but so it's just wearing me out. The other thing is I'm also looking to merge my firm, my financial planning firm, with another firm. And I've kind of talked to a few of you individually, and I'll continue. And as I said, I don't have all the details on all the transition, what it's going to look like for you yet, but we're working on it. And I'm merging in with a Coast Guard Academy classmate of mine. He focuses on money management and hasn't focused on financial planning. I'm going to come in and kind of ramp up the planning side of the business along with another CFP. So we're really excited. We think at the end of the day, what this is going to do for you is get you a lot more attention. So the fact that I've been in the tax office, I haven't been able to spend as much time with clients, planning clients. That'll change. There'll be more interaction. We've got some great tools that we're going to get to you. So you're going to get a lot more tools that you can use. And we're going to try to really get a lot more education like this out to you. So it won't just be once every couple of weeks. It'll be every week, maybe 2 or 3 times a week. We're going to get a lot of information to you. You may not want to consume any of it, and that's fine, but we're going to try to give you a lot more attention, whether it's through personal softwares or education. We're really going to try to get that stuff out to you. And we're trying to build a firm that we feel like this is where the industry is moving, and we want to be ahead of the curve. And hopefully that's what we'll build here. But I'm going to continue to just let you know through these and then on one-on-one discussions what's going on. But yeah, I just want to kind of let you know, wheels are in motion. So if you have questions on that, just let me know. So again, a little shorter than usual, but that's fine. It's a beautiful day outside. So get outside and enjoy this beautiful weather. And I'll be talking to you all soon. Take care.